In a few days, on the 18th of June, the Bank of England is going to make a decision that thousands of people are waiting on before they invest a single pound. And I want to tell you why, if you're waiting for that decision before you make your move in property, you might be asking completely the wrong question. I'm Kayley from the Yorkshire Property Sourcer. Let's talk about it. So here's where we are right now, and I'll be honest with you, the picture has changed a lot in the last few months. At the start of this year, almost everyone agreed on one thing: interest rates were going to come down through 2026. Inflation was falling, the economy was slowing, and rates cut looked nailed on. Then the conflict in the Middle East changed everything. Oil prices spiked. Brent crude went above $126 a barrel, the highest in 4 years. Energy costs feed straight into inflation, and suddenly the Bank of England's careful plan went out of the window. Base rates held at 3.75%. Next decision 18th of June. At their last meeting, the bank held the base rate at 3.75. But here's the detail most people missed. The vote was 8-1, and the one who disagreed wanted to put rates up, not down. Let that sink in for a second. We've gone from when will rates be cut to economists seriously debating whether the next move is a rise. In fact, in one recent poll, 14 economists said they'd expect at least one rate rise this year. And you can see it in mortgage rates already. At the start of March, the average 2-year fixed mortgage was around 4.8%. By the end of May, it was 5.7%. That's a big jump in the short space of time. And if you're an investor, it directly affects your numbers. So that's the backdrop. Uncertainty. Rates higher than expected. Nobody really sure what happens on the 18th of June. And in the environment, the natural human instinct is to do one thing: wait. Now, I completely understand the temptation to wait. You've got capital, you're sensible, why not? Just sit tight until the picture is clearer and rates come down. Here's the problem with that. Waiting for clarity sounds responsible, but in practice, it usually means waiting forever because the market never actually gives you clarity. There's always something. If it's not interest rates, it's an election. If it's not an election, it's a global event. And if it's not that, it's a budget. There is never a moment where everything lines up perfectly and a little bell rings to tell you it's safe to invest. The investors I've watched build real wealth weren't the ones who timed the market perfectly. They were the ones who bought good assets in good areas at sensible prices and then simply held them through every bit of noise that came afterwards. And here's something genuinely interesting. Despite all this uncertainty, the war, the inflation, the rate worries, do you know what UK house prices actually did? According to Nationwide, they're still up 3% over the year. The headlines panicked, the fundamentals just carried on. That's the gap between what the news tells you to feel and what's actually happening on the ground. Now, I'm not going to pretend interest rates don't matter. Of course they do. They affect your mortgage payment, and your mortgage payment affects your cash flow. But here's what most people get wrong. They think the interest rate decides whether a deal works. It doesn't. The deal decides whether a deal works. Let me show you what I mean with a real example. The kind of deal we exactly do. Picture a 3-bedroom terraced house in Castleford. Purchase price £120,000. You'd put down a 25% deposit, that's £30,000. Add stamp duty and legal costs and you're all in for around £38,000 of your own money. That house rents for £900 a month. The mortgage on an interest-only buy-to-let, current rates is around £315 a month. Take off management and a maintenance buffer and you're left with roughly £495 a month in your pocket every month. That's a 9% gross yield and around a 15% return on the cash you put in. Now here's the important bit. What happens if interest rates go up by 0.5%? Your mortgage payments go up by maybe £40 or £50 a month. Your 495 becomes around 450. Is that ideal? No. Does it break the investment? Not even close. It still pays you every single month. Compare that to a property in London or the South East, where the yields are so much thinner, often around 5%. That rate rise can wipe out your cash flow entirely and tip you into losing money each month. This is the whole point. A deal with a strong enough yield has a cushion built into it. It can absorb a rate rise and still work. That cushion is exactly what we look for. It's why we focus on Yorkshire, where the numbers leave room to breathe, not on areas where you are relying on everything going perfectly just to break even. So when people ask me, should I wait for rates to fall? My honest answer is, if a deal only works when rates are low, it was never good enough. A good deal works at today's rates, and it gets even better if rates fall later. And there's one more thing, and this is the part almost nobody talks about. Higher interest rates and higher inflation are frightening if you are a saver with money in the bank. But if you're a property investor, inflation quietly works in your favour 3 times over. Your rent rises with inflation, the value of your property rises with inflation over time, and this is the one people miss: your debt shrinks. Think about it. When you borrow £80,000, that number is fixed. It never grows. But everything around it inflates. Wages, rent prices. So over the years, that debt quietly becomes smaller and smaller in real terms until one day it feels almost trivial. Your tenant is paying it down for you the whole time through their rent. So that very thing that's making everyone nervous right now, inflation, is the same force that quietly makes assets owners wealthier. Money sitting in a savings account is losing value to that inflation every single day. Money in a well-bought property is riding it. That's the reframe. The environment that feels scary for savers is often quietly brilliant for investors who own the right assets. So what should you actually do with all this? Don't wait for the 18th of June. Don't wait for that perfect moment that never arrives. Instead, do the boring, sensible things. Get educated on the numbers. Understand what a genuinely good deal looks like. The yield, the cash flow, the cushion. Pick an area with real fundamentals behind it. Employment, investment, transport, affordability, and buy something that pays you from day one at today's rates with enough margin to handle whatever the Bank of England does next. Because here's the truth. The people who will look back in 10 years and feel clever aren't the ones who guessed the June rate decision correctly. They're the ones who stopped waiting, bought good assets, and let time do the work. The rate decision is noise. The fundamentals are the signal. Now, if you're someone sitting on capital watching all this uncertainty and thinking there has to be a smarter way to put your money to work than leaving it in the bank losing value to inflation, that's exactly what we help people with. We find the deals in the right Yorkshire areas with the numbers that actually stack up. Completely hands off. If you'd like to understand how that works, I've put a free investor pack in the description. No pressure, no obligation, just the clearest way to see whether this is a fit for you. But whatever you do, please don't let a day on the Bank of England's calendar decide your financial future. The best time to understand this stuff isn't after the decision, it's now. This is Kayley, the Yorkshire Property Sourcer, helping you invest in property the right way. I'll see you in the next video.